Welcome to our discussion on a powerful concept in the world of investing, dividends. For many beginner investors, the idea of earning passive income from their investments can seem complex. Today, we will demystify dividends and show you how they can become a cornerstone of your financial strategy. Understanding dividends is crucial for anyone looking to build long-term wealth. They offer a tangible return on your investment, often paid out regularly. Let's explore how these payments work and why they matter. Simply put, a dividend is a distribution of a portion of a company's earnings to its shareholders. When you own shares in a company, you own a small piece of that business. As a part owner, you are entitled to a share of its profits. Companies typically pay dividends in cash, directly deposited into your brokerage account. These payments are usually made on a regular schedule, most commonly quarterly. Think of it as a reward for owning a piece of a successful business. Companies pay dividends for several strategic reasons. It's often a sign of financial health and stability. A company that consistently pays dividends usually has strong cash flow and a mature business model. Paying dividends can also attract and retain investors. Many investors seek out dividend-paying stocks for their income-generating potential. It signals confidence from management in the company's future earnings. While cash dividends are the most common, it's good to be aware of other types. Sometimes, companies issue stock dividends, where you receive additional shares instead of cash. Special dividends are one-time payments, often after an exceptionally profitable period. For the purpose of passive income, our focus today will primarily be on regular cash dividends. These are the payments that consistently contribute to your investment income stream. When evaluating dividend stocks, several metrics can help you make informed decisions. Understanding these numbers will give you a clearer picture of a company's dividend sustainability and attractiveness. Let's break down the most important ones. Dividend yield is a crucial metric for income-focused investors. It expresses the annual dividend payment as a percentage of the stock's current share price. A higher yield means more income relative to the stock's price. To calculate dividend yield, you divide the annual dividend per share by the current share price. For example, a stock trading at $100 with an annual dividend of $4 has a 4% dividend yield. It helps you compare the income potential of different stocks. The dividend payout ratio tells you what percentage of a company's earnings are paid out as dividends. It's calculated by dividing the total dividends paid by the company's net income. This ratio is vital for assessing dividend sustainability. A very high payout ratio, say over 80 to 90%, might indicate that the company is paying out too much of its earnings. This could leave little room for reinvestment in the business or make the dividend vulnerable to cuts during tough times. A healthy payout ratio often falls between 30% and 70%. Beyond the current yield, consider a company's history of dividend growth. A company that consistently increases its dividend payments over time demonstrates financial strength and a commitment to shareholders. This growth can significantly boost your long-term income. Look for companies with a track record of raising dividends annually. This indicates a resilient business model and management's confidence in future profitability. Consistent dividend growth can outpace inflation and enhance your purchasing power. One of the most powerful strategies for dividend investors is dividend reinvestment. A dividend reinvestment plan, or DRIP, allows you to automatically use your cash dividends to buy more shares of the same stock. This simple action supercharges your returns. By reinvesting dividends, you harness the power of compounding. You earn dividends on your original shares, and then those dividends buy more shares, which then earn even more dividends. Over time, this snowball effect can lead to substantial wealth accumulation. There are various approaches to dividend investing, depending on your financial goals. Some investors prioritize immediate income, while others focus on long-term growth. Let's explore a couple of common strategies. If your primary goal is to generate a steady stream of passive income, you might focus on high-yield dividend stocks. These are often found in mature industries like utilities, real estate investment trusts, or consumer staples. The emphasis here is on consistent, predictable payouts. However, always balance yield with sustainability. A very high yield could be a yield trap, signaling underlying problems with the company. Always research the company's financial health and payout ratio. This strategy seeks a balance between current income and future capital appreciation. Investors look for companies that pay a respectable dividend but also have strong growth prospects. These companies often have a history of increasing their dividends. This approach aims to benefit from both the regular income stream and the potential for the stock price to rise over time. It's a popular strategy for long-term investors looking for a blend of stability and growth. For those seeking extreme reliability, consider dividend aristocrats or dividend kings. Aristocrats are S&P 500 companies that have increased their dividends for at least 25 consecutive years. Kings have done so for 50 years or more. These companies represent the pinnacle of dividend consistency and financial strength. Investing in them can provide a strong foundation for a reliable passive income portfolio. They are often leaders in their respective industries. While dividends offer attractive benefits, it's important to be aware of the potential risks and considerations. No investment is entirely without risk, and dividend stocks are no exception. Understanding these factors will help you invest more wisely. A crucial point to remember is that dividends are not guaranteed. A company's board of directors can choose to reduce or even eliminate dividend payments at any time. This often happens during economic downturns or if the company faces financial difficulties. Always research a company's financial stability and its history of dividend payments. A long track record of consistent payments is a good indicator, but it's never a promise of future performance. A dividend cut can significantly impact your passive income and often leads to a drop in the stock price. This is why the dividend payout ratio is so important. A company paying out too much of its earnings is more susceptible to cuts. Diversifying your dividend portfolio across multiple companies and sectors can help mitigate the impact of a single dividend cut. Don't put all your income eggs in one basket. Dividend income is generally taxable. In many countries, qualified dividends are taxed at a lower rate than ordinary income, but this can vary. It's essential to understand the tax implications in your specific jurisdiction. Consider consulting a tax advisor to understand how dividend income will affect your overall tax situation. This knowledge will help you plan your investments more effectively. Be wary of yield traps. These are stocks with unusually high dividend yields that might seem attractive at first glance. However, a very high yield can sometimes signal that the market expects a dividend cut or that the company's business is in decline. Always investigate the reasons behind an exceptionally high yield. Look at the company's fundamentals, debt levels, and industry outlook. A high yield from a struggling company is often a red flag. Finding suitable dividend stocks requires research and due diligence. There are several tools and resources available to help you identify potential investments. Start by using stock screeners. Many brokerage platforms and financial websites offer free stock screeners. You can filter companies based on criteria like dividend yield, payout ratio, market capitalization, and dividend growth history. This helps narrow down your options. Once you have a list of potential candidates, dive deeper into their financial statements. Look at their revenue growth, profit margins, debt levels, and cash flow. Read their annual reports and investor presentations. Consider companies with a strong competitive advantage, often called a moat. These businesses are more likely to sustain their profitability and dividend payments over the long term. Think about companies that produce essential goods or services. Dividends offer a compelling path to building passive income and long-term wealth. By understanding what they are, how to evaluate them, and the strategies involved, you can make informed decisions. Remember, consistency and reinvestment are your allies. Start small, educate yourself continuously, and always consider your personal financial goals and risk tolerance. If you're unsure, consulting a qualified financial advisor can provide personalized guidance. Happy investing, and may your dividends grow.